Another month and another all-time high for the SP 500. But how long can this bull market in stocks continue? And should we now be really starting to worry about a much deeper sell-off and potentially a market crash? Here's the broader US stock market index since the March low, the coronavirus pandemic inspired low, when markets and investors really started to panic around the world. Very sharp sell-off down towards 2,200. And then here we are this year, once again, this month, this week, the market has pushed out to fresh all-time highs. So it's one that continues to reward investors for buying the dips and having exposure to stock markets. The S&P, I think, is a great market to watch if you want to watch stock markets, because it is the main US broader index. It's a benchmark used around the world. But the question is, how long can it carry on going up for? Do we really need to start thinking about perhaps reducing exposure, selling short, not buying dips anymore, all of that? So as usual in this video, I'll talk about the pros and the cons for a market continuing either to push higher, or actually should we be getting ready for it to roll over? And I'll see if there's a trade to do. We do have one trade running on the S&P. It's done all right since 17th of December. Opened up the trade buying at 37.24. So it's just under a couple of hundred points in profit, that one, up around £170 or so. So we need to think about moving the stop loss on that. But given the strength in this market, there has to be another trade to do. So we'll come back, look at this in more detail in a few minutes' time and set that up. Hello, I'm David Jones from Capital.com, and I thought let's do an update on stock markets. Let's focus on the US stock market, the S&P 500, do a longer term outlook, see what we can expect in the months and perhaps the year ahead, but also look at the short term as well and see if there's another trade to do. As usual, if you're watching this and you haven't subscribed, if you could subscribe, we push out 3 or 4 videos a week on different markets. And of course, we now do these live streams every Friday. The next one is going to be this Friday, 2:30 in the afternoon UK time. They're proven to be really popular. We look at lots of different markets. So if you're subscribed with the alarm bell notification pushed, that alarm bell thing, you'll get a notification off YouTube just as we're about to go live. Right, let's get into it. Let's take a look at stock markets and see, can we expect further gains, or is there a crash just around the corner? So let's deal with the facts first of all. Already this month, in February, in the last 24 hours or so, we've seen the S&P 500 move out briefly to fresh all-time highs once again. So if we go back and look at things since the beginning of 2020, so just over 13 months, the S&P has returned about 21%. Just over the last year and a bit. For the year to date, so far, we're 6 weeks into this year, the S&P is up by about 4%. These are great performances. Of course, we had massive volatility last year, as we know, really strong bounce back off those March lows following the spread of the coronavirus pandemic. And that strength has continued into this year. But there are lots of arguments to say, well, the market is at real risk of hitting a top and having a big correction, if not a more pronounced bear market. If we look at the earnings of the companies that make up the S&P, then the S&P 500 index is trading at more than 30 times earnings at the moment. It's about 34. I did check before I started doing this. It's higher than it was in 1929, the great Wall Street crash. So on an earnings basis, it's a market that does look expensive, but it keeps going up. We did a video, I think, back in January about whether the stock market is in a bubble. And back then, Jeremy Grantham of GMO, massive money manager in the USA, said that we're actually in the middle of one of the great bubbles of financial history when it came to stock markets. The problem is, of course, even if you do think stock markets are a bubble, bubbles can carry on a lot longer than we expect before they go pop. So timing the top is always difficult, if not impossible. Another sign of a market top, classic sign of a market top, is increased public participation. So people who wouldn't normally be involved so actively in the stock market, suddenly everyone's talking about the stock market. And I think you could definitely say we are seeing that. There's no greater example, I think, than what we saw in recent weeks with GameStop, the US stock that got lots of traction on Reddit, on Wall Street Bets, on the forum there, and we saw the price go absolutely parabolic before, of course, come crashing down. So we do have a lot of wider public participation in stock markets, and I think historically you'd say that's when you want to start getting nervous. But saying all of this, the market definitely looks like it's overdue some volatility. We had lots of volatility last year, of course, in March, when we saw the market really fall off a cliff. But when we do get sell-offs, and we get maybe steeper sell-offs, they're not really that steep though in recent weeks, investors and traders appear only too happy to jump in and buy the dip. So for me, even though, okay, there's a risk of clearly some sort of correction, there always is in markets, for now at least it's a market that is still strong. You'll know from watching all the different markets that we look at on this channel over the years, I'm a massive fan of following trends. If you've been following the trend in the stock market, you've been really well rewarded. It was only yesterday this market touched fresh all-time highs. This trend is still up. So for me, I'm still expecting further gains, but we'll look at it in more detail in a second. Let's talk about the levels to watch first of all, then we'll get on and get a trade on. Because we are at all-time highs, when it comes to picking out resistance levels, we're just at a psychological finger in the air sort of level. So 4,000 is an obvious one. The market traded above 3,900 yesterday, so 4,000 looks like a next obvious hurdle. And after that, some other psychological levels that I've plucked out. On the downside is where it gets more interesting. And I think just below 3,700, an important low from January, some other levels after that. There have been plenty of support levels, lows left on the way up that are well worth watching if we do get a deeper correction. But let's put some color on these numbers and look at things in more detail and come up with a trading idea. So for me, the trend is all important in markets, and we have a clear trend in the S&P 500. We'll explore that in a bit more detail in a second. Before we do that, let's take a look at the indicators. So in the past, I've warned about the risk of using the RSI, overbought, oversold, in strong trending markets, because the problem is the RSI will try and get you out of a trend too quickly. And you can see it's bumped up near overbought for the best part of 3 months or so. We get the sell-off out of overbought as the market corrects, and then pretty quickly it's back up there again. So I'd question perhaps the use of just overbought, oversold on the RSI. But what is interesting, I've talked about the idea of divergence in the past, where the market does one thing, but the indicator does something else. And this is going on at the moment in the S&P 500 and a 10-day RSI. So in January of this year, the RSI moved overbought for the first time this year. The market hit a high, drifted for a few days, then pushed higher, but the RSI made a lower high. The market drifted, sold off sharply, bounced back again to fresh all-time highs yesterday. But the RSI has made a lower high. So we have triple bearish divergence effectively going on in the RSI at the moment. So again, it's a suggestion that perhaps it's getting a little bit tired up at these levels. But for me, the trend would still trump that. But this triple divergence is quite a rare thing to see. So it's quite an interesting thing to keep an eye on how it plays out over the next few weeks. Perhaps we'll get a bigger correction than we're used to. But for me at the moment, I still view that as a buying opportunity. Looking at the MACD down here, the last signal we had was early Feb on the way up, on the bounce. Looking to buy in. MACD is still long, so the MACD is still going with that trend despite the divergence that we see setting up on the RSI. Let's take a quick look at the Bollinger Bands. Volatility has peaked up during February. Bollinger Bands, measure the volatility in a market. We have seen the Bollinger Bands move out fairly wide, and we'd have to go back to probably November of last year to see them this wide compared to where they were trading December, January. And I think clearly it's that sell-off we saw towards the end of January that knocked the Bollingers out a bit wider. So again, it does suggest with us trading near the top of the bands that perhaps we could get a correction. But again, for me, any weakness back to 3,800 or even down to 3,700, which was only the lows from the end of January, let's not forget, I'd still view this as a buying opportunity. Let's get into this trend. So if I pick it up off the lows, the March lows last year, the second touch here, the end of October, and we had the third touch into the end of January. So we've got a good trend line chugging along, supporting the market at the moment. That trend line is coming in around 3,700, 3,710, that sort of level. Lots of support. If you look at the lows for this year, we had a low in early January around 36.60. Then we have that low end of January, 36.64. So again, 36.60. Big support for the market. Bigger support out at 3,600. Then bigger support again out at 3,500 from November. And for me, that's probably the level to watch. I think only if we broke below 3,500 would I start to worry that actually the recovery, this trend is running out of steam. So for me, from a trend following point of view, I am happy to be a buyer if we get dips back to 3,500. I'd only change my mind if that breaks. So I think this trend still looks healthy. Okay, in the short term, we have that divergence on the RSI. So maybe we get a correction. But for me, no signs of an impending crash at the moment. Let's take a look at the shorter term and set a trade up. So this is the month of February so far. On an hourly chart, we've got the most recent all-time high, which was actually set outside of market hours, an hour ahead of the US Open. That's in at 39.35. What I'm going to do, I would like to place a trade, but at the moment, I'd like to buy some more strength. So if we see the market break out to fresh all-time highs, I want to be a buyer. So I am going to put my buy order in at 39.40. So if the market gets to 39.40, I'm going to assume the next leg higher is underway. Clearly, there'll be plenty of momentum to have driven it up to there. The only question, as usual, is where does my stop go? The tightest I'd want my stop, we had this sharp sell-off on Wednesday of this week, down towards 38.84 is where it traded. So the tightest I want my stop is probably the other side of there. But what I'm going to do, I'm going to pick up on these lows from the 3rd of Feb, coming in around 38.15, that sort of level. So to make it easy for me, I'm going to go 3,800 for a stop. So I'm a buyer at 39.40 with a stop at 3,800. That's only where it was, 10 days ago. Let's set that up and see if it gets filled. So I'm ready to go. The market at the time of recording is trading at 39.21. So I would like to buy 2.5 of the S&P. I can trade fractional on here at 39.40 if the market gets to 39.40. So I'll buy into strength. If we don't get filled and the market sells off, we'll review it again. If that order gets filled, put a stop loss in at 3,800. So you can see both of those levels now highlighted on my chart where my potential order is going to go in here. And as usual, I've sized the trade, so my risk is going to be around £250. The normal risk on the trades we place. I am thinking about increasing the risk in March. We'll see where the account ends in February. But for me, at the moment, we're at 250 risk. That's it. Let's place the order. So my order's placed, buying 2.5 S&P if it gets to the 39.40 level. If I go and have a look at the portfolio, and if I go into orders up here at the top, so there's my S&P order I just placed. So buying 2.5 if the market gets to 39.40. It's about 20 points higher than where it is now. If that order gets filled, put a stop in 140 points away at 3,800. Let's take a look at the existing position. So as usual, a bit of a mix of trades at the moment. The best performing is crude oil. We got a whole bunch of trades on crude oil running. And of course, crude oil has been very strong. The Tesla position has been running for ages. But there's the old S&P position from the 17th of December. So what I'll do, I bought that at 37.24. Let me just move the stop loss up to break even. So let's do that now. So I've changed the stop on that to break even. So I've got a risk-free position there. As usual, we'll take a look in a bit more detail on the live stream this week. So join us if you can, or watch the recording at all these different markets. But for now, I'm happy with that. If the market breaks higher, I'll be in on hopefully what ends up being a major leg higher again. We do have that divergence on the RSI, which is perhaps a bit concerning. But for me, I'd treat it as a buying opportunity if we do get a sell-off. At the time of recording, all still strong, and that trend definitely still going. That's it for the update on the S&P. Still strong. We'll see how long it lasts. But from me, David Jones and Capital.com, we'll leave things there. Good luck with your trading. For more trading videos just like this, please subscribe to our channel.